Hi, Trudy Kohler here with At Home Property Group, and welcome to my video blog. I've asked a very special industry leader to join me today on my video blog. This is Eric Denlap from Peak Mortgage here in Portland, Oregon, and Eric is my preferred lender, and I've asked him to come to talk to us today about the pre-approval process and really what kind of questions should a buyer be asking their lender. So stay tuned. All right, Eric, thank you so much for being here today. I really appreciate it. Let's start with the pre-approval process. Can you go over briefly what's involved?
Yeah, so typically I get a referral from an agent like you, and I end up having a phone conversation with the client. It takes typically about 10 minutes over the phone to find out some of their income information, their asset information, just their general finances. That information gives me enough to kind of get started and tell them basically what we can do as far as a loan approval would go, and that takes about 10 minutes. Once we've got that initial conversation has taken place, then I would do a full loan application with them over the phone, get all their financial information, social security numbers, dates of birth, employment histories, all that sort of thing, which takes probably another 5 or 10 minutes. And at that point, I would get their credit pulled and let them know what sort of loan programs would be available for them.
Okay. And what about a down payment? A lot of people ask me, do I really need 20%? Can I put down 5%? Can you talk to me about the down payment?
Yeah, so there's different down payment requirements for different loan programs. FHA has the broadest guidelines and is the simplest to qualify for, and that requires a 3.5% down payment. There are conventional loans that require as little as 3%, in many cases 5%, and possibly above that all the way up to 20%. So it kind of depends on the financial situation of the client as to what they're going to qualify for.
What about mortgage insurance? Can you just speak really briefly toward that? Because that's where the threshold of 20% comes in, correct?
Exactly. So mortgage insurance is required on any loan where the borrower is putting down less than 20%. And the mortgage insurance cost is tied directly to people's credit scores and the amount of money they're putting down. So the more money you put down and the higher your credit score, the lower your mortgage insurance cost is going to be.
Okay, wonderful, wonderful. All right, well, thank you so much, Eric. I really appreciate you being here today. If you have any questions for me or Eric, please feel free to reach out. Eric's information is below, and I will see you soon. Thanks.
Thank you.